Let's talk about Core Plus investing. Core Plus is best understood by comparing it to the core strategy. And what the plus is that there's some component of Core Plus that slightly falls outside of core. So let me take you through that. Most importantly, Core Plus is about buying stable income-producing assets that have a relatively low risk profile. So it's very similar to core investing, and we're looking for a history of income production and a proven ability for that asset to continue to produce income distributions to you as an investor. On the Core Plus side, the plus component is maybe we're achieving the rate of return that we're achieving with a little bit more leverage, a little bit more debt, or maybe it's a Class A asset, which is a great asset, in a Class B location, or a Class A location for that asset, but maybe an older building, so a Class B asset. It's usually some combination of these factors that takes it from core to Core Plus. A great example of Core Plus investing would be the behavioral health hospital Caliber recently completed in an opportunity zone in Phoenix, Arizona. If a new buyer came in and bought that property from us for approximately $40 million, using 60% leverage, which falls in the Core Plus strategy, they would be earning an annual rate of return through the cash flow of about 8% per year. In addition to that, they could expect that the property would appreciate naturally with the market, which puts them in that 8 to 12% a year return. That property is only a $40 million purchase. It's below the $100 million requirement for core. So what Caliber can do in order to sell that to a core investor in the future is we can build multiple behavioral health hospitals, package them into a single sale, and sell it to an investor into the hundreds of millions of dollars, which gives them the rate of return they're looking for with the size and scale that they need. Aggregating smaller Core Plus assets into a larger portfolio is one of the most valuable things that firms like Caliber can do to service the institutional market. For investors, this is a huge opportunity for you because as you invest each layer of the aggregation, the development of the initial property, the property once it's cash flowing as a Core Plus asset, you get to participate in the upside from that future sale. Another risk factor in Core Plus investing is the Class A building in the Class B location or the Class B building in the Class A location. In both cases, you're dealing with different risks. For the Class A building in a Class B location, you're dealing with the fact that because that location is a little bit lower in value to the tenant, they may choose to move to a better location during a recession because they might be getting a cheaper rent. On the other side of the equation, if you have that Class B building in a Class A location, you might be facing more deferred maintenance. So you might have to take some of those rents that you were normally distributing and use them to fix up the building or deal with a major mechanical failure or other issues that happen as buildings age. Also on the risk factor side, Core Plus does produce a higher rate of return than the core strategy. Fairly similar risks. Usually one of the things that's driving that rate of return higher is a higher use of leverage. So if you're uncomfortable with the idea of us borrowing 60, 65, up to 70% loan to value against an asset to produce that higher rate of return, then you're going to want to stick to the core investing strategy versus Core Plus. In our opinion, even at that higher rate of leverage, you're going to see, like I said, very similar risk because the assets are fairly stable. The return profile for Core Plus investing is typically an 8 to 12% annualized return with a similar level of cash flow to core investing, around 6%, maybe up to 8%, and the rest of it being additional growth in the value of the asset per year. That comes from the fact that Core Plus assets typically are harder to acquire and have less competition than core assets from large institutions. So that means we can buy them better and we have a bigger upside on sale. To wrap up on Core Plus investing, like I said before, you should expect an 8 to 12% annual rate of return, which is actually better than typical stock market averages in the second lowest category of risk in real estate investing. It's a great combination of risk and return, and for investors looking for stable income in your portfolios, it's a wonderful strategy to pursue. So how do you move from the 8 to 12% return category to a higher return category? What's the next step? That's value add investing, which is a really exciting strategy that comes and goes depending on the status of the real estate market. Sometimes there's a large opportunity for value add investing. Sometimes it's one of the hardest things to do in real estate investing. That's where we'll go to next.